Hi, good evening, everyone, and thank you, Dev, for a very, I would say, great introduction. I don't think if I deserve that or not. First, a few disclaimers before I start. Disclaimer number one, uh, all of you in this room, most of you are senior than me, and I think I should have been sitting there learning from you, but I was given this opportunity, so I'll try to do justice to your time. I don't guarantee whether I'll be able to do or not. Second disclaimer, I had done this presentation a couple of months back, so if anyone in the room who has been a participant earlier, I'm really sorry for that. And third, I have been allotted 10 minutes, but there is no timer here. So somebody, if you can help me when it is 10 minutes, then maybe I'll stop there. So the topic which I'm going to discuss, there's no topic here, so I'll try to tell what is the agenda. About the behavioral edge. So when I was listening to two eminent speakers before me, the idea was uh, how to engage with the client, how to onboard the client, how to figure out whether the client is happy or not. I would take a little tangential approach where I would say that maybe all of us in this room are not as important as our clients. Maybe all of us in this room are not smart enough to generate alpha or return or wealth creation in the long term, what a client's behavior can do. The presentation is divided into two parts. First, I'll take why behavior is important, and second, what are the few things which we can do to make sense out of it. So, okay, I'll stop here for 10 seconds if it was needed, otherwise I'll jump. So this is a data which is a little dated, but it's a calendar year data, so it will not make any difference. So what we have tried to analyze here is that there are funds, there are indices, there are returns, and then there is a return of the investor. What we have seen over a period of time in India, outside India, the return which an investor makes and the return which a fund generates, there is a difference between that. In this sheet, I have taken Nifty 500 TRI and not the returns of the folios at an average level, but the difference would not change much other than the expense ratio. If we see the data for 10, 11 years, you would see that for most of the years, the last column is negative, which means market is giving return, but not all investors are getting return. Now, this brings us to an important question. Are we not doing our job properly? Or is there something else which we are missing? So to understand that, whether we are important in the overall schemes or thing or not, I did a very small exercise, went to value research, figured out generally what we do when we analyze our client's portfolio, when we do our recommendation, we go for the top 3, 4, 5 funds, then try to extrapolate the future returns and then try to recommend those. But I did the reverse. I thought, let me go to the backbenchers of the class. Let me go to the worst performing or the bottom performing funds over a 10-year period, and then let's see how the returns have come from those. And I have figured out the 10-year CAGR on SIP and the normal one. So if you see here, FlexiCap, the last fund, there were 29 funds which have completed 10 years. The return generated on a CAGR basis is 12%. Mid-cap, 18%. Small-cap, 18% plus. Even a very, very conservative category like hybrid generated a return of 11.4%. And then there are benchmark return, which varies from 15 to 16%. So what I'm trying to say here is that even if there is an investor who's extremely unlucky, who ends up investing for next 10 years in one of the worst performing funds in terms of performance, if the advisor is not very astute and he also ends up recommending a fund which ends up being the worst performing fund, still at a blended level, if the portfolio was equally divided among all these categories, the investor would have made a return which would have been in the range of 13 to 14%, which would have A, beaten inflation, B, helped the investor reach his or her desired objective from his wealth. Now, why does that happen? Let's try to understand the basic, which I think most of you knew, because I didn't know that what kind of vintage would the audience have, so I have tried to be a little basic in certain slides. Apologies for that. So principal into rate raised to the power time. Now, what is in our hands as advisors? Actually nothing, but we can take claim that, okay, we can generate higher R on your portfolio. Maybe you're doing fixed deposit, I can recommend you FMP. Maybe you're doing long-term bond, I can recommend you equities. Maybe you are doing at a blended level FD plus direct equity. I'm recommending you hybrid fund and I can generate some R. So maybe I have some role to play there. Principal, if an investor is earning 100 rupees, he or she can at the max invest whatever is saved out of that. So principal can't be stretched beyond a point. What is important here is the exponential factor, which is time. And who controls time? Does advisor control it? The answer is no. Does the fund manager controls? The answer is no. The time is very much in the hands of investor. And that's where time and again we say that return generation is a function of investors' behavior to a large extent. Maybe we are the supporting roles, but the Shah Rukh Khan in the room when it comes to wealth creation is investor and not the fund managers or the advisors. Now, I've tried to figure out certain biases which play out when we do this, and I'll try to explain it to certain things. So today, coincidentally, while we're talking, IPL is going to start. So I took example of football. Now, if you see football, what happens? Certain games end up going to penalty shootouts. And in penalty shootouts, if you would have observed, the goalkeepers try to be very, very acrobatic. They try to jump on the right or on the left. Sometimes they save goal. Most of the time, they don't save goal. Coincidentally, the last World Cup was also decided on penalty shootouts. Now, if you take data and analyze, if a goalkeeper doesn't do anything, stands in the middle, legs open, hands open, the probability of defending the goal will increase from late single digit to around 30-35%. Now the question is, goalkeepers do understand that. If they stand in the middle, if their arms open, legs open, they can defend it. Why don't they do that? Because they have to justify their existence. Let's assume you are a goalkeeper. You go to your manager, and your manager says, look, you were beaten down by the opponent, and you were just standing in the middle. So what is the reaction? He will say that, okay, I don't want you. But on the other hand, the other guy has jumped, overwhelmingly to the right or the left, and the process at times have injured himself also. He or she may get the benefit of the doubt that at least he tried. So the problem is, since the time we have been born, our parents keep on telling us, our teachers keep on telling us, don't sit idle, keep doing something, whereas in investment, it's the opposite. Don't do many a thing, because when you try to experiment, when you try to jump on the left or the right, eventually you end up ceding the goals and not defending the goals. Now, the other major problem which we face in this industry, across the board, news analysts, WhatsApp influencers, Instagram influencers, even fund managers, they fall prey to this, is the game of prediction. Now, let's look at this data. At the beginning of 2023, and these are all the firms where much more smarter, very highly paid people work. Everyone from Morgan Stanley to Wells Fargo to Goldman Sachs, this is the return they predicted at the beginning of 2023 for S&P 500, what it would generate prospectively. The range of return was -4 to 12%. In reality, the return which we got from S&P 500 was more than 20%. Leave aside markets. Let's come to economy. US economy. The growth rate for the last year was around 2.5, 2.6%. At the beginning of the year, everyone in the room was saying that there would be recession. All analysts, all economists, Nobel laureates, they were all saying recession is going to happen. Soft landing or hard landing is something which is not clear. What happened in the end? The economy grew at a much, much faster pace. Leave aside recession, it beat the estimate by a significant number, and 2.5% for an economy which is of that size is not a small number. So what I'm trying to say here is that if these guys, and I'll give you a number, US Fed has 430 economists on its roll. Most expensive economists in the world, they end up working there. And these 430 people could not predict what their economy is going to do 12 months going forward. How can people in this room, you and me, we can predict whether large cap will do this year well, small cap will crash tomorrow, or what is going to happen? So let's not get into the game of prediction, because it's planning which plays out in the long term. Now I'll try to club two slides. First, I'll move here, overconfidence bias. And why I say overconfidence bias, when I meet people, they say that I don't do fixed income, I do only equities. I don't do hybrid fund. If I do hybrid fund, if I do BAF, then what is my role? I do large cap fund, small cap fund, mid cap fund, and debt as a combination, but I manage it myself. I do only SIPs. I don't believe in passive. I would do large cap only for senior citizens. These are the kind of things which we end up saying. And at times I feel, who are we trying to prove right or wrong? Is it that we are in the wealth creation journey, or we have our own ideologies which we are trying to stick by? And now I'll go to the previous slide. Hong Kong, 1997, 1998, a very vibrant economy. At that point of time, somebody would have said that, look, I am in a country which is doing good. Like India, the story seems to be very, very good. Everything is good. Let me invest my money into Hong Kong. The index level today, this is a little dated presentation. I think today it is around 16,000 change. The level of Hang Seng in 1999 and 2024 is same, which means over a period of 25 years, the index has not generated any return. If I take example of US, 1969 to 1981, return generated by S&P 500 was negative, and the bond yield at the end was trading, I think US Treasury was at around 15% odd or so. Japan, 34 years, no return. It's not that we are God's gift to mankind. Something can happen to India also. We are emerging economies, we are growing, demography is on our favor. I don't deny that. But too much of overconfidence on a country, on a geography, or on a market, or just the equity market of a country may at point be detrimental. And that's what I have written here, that one is overconfidence bias, and second is benchmark obsession. Now, we all discussed that my portfolio is generating 1% above benchmark, 2% above benchmark. Imagine I was your advisor. We invested in Hong Kong. I generated 1% alpha over benchmark. And I come to you after 25 years and say, look, sir, I have generated 1% over benchmark. He asked me, what is the absolute return? I say 1%, because benchmark has given 0, I have given you 1%. Does it help that investor? His goal or her goal is to have money for his retirement, for his children's education, for whatever purpose. And here I am giving him gyan on benchmark beating returns which I have generated. So two learnings from this. One is overconfidence should be a little lower, because we are all humans. Countries are run by people. Things can go wrong, and things have gone wrong in the world many a time. And second, benchmark obsession at times can lead us to a situation where the objective is not wealth creation, but objective is benchmark tracking and benchmark beating, which may not be good for the client in the overall term.
Harsh, I think we are there with the time. Yeah.
Okay. So maybe I'll just, I think I have 2 more slides. I'll try to quickly cover. This is about what mistake we do. And I think social media is responsible for that. You would get a message, don't smoke a cigarette a day. If you save that, you will be millionaire in 100 years. Why did you buy Maruti car? You should have bought Maruti stock. You bought a Bullet motorcycle. You should have bought Eicher stock. Don't consume a beer today evening. Today is Friday, because if you don't consume it, you save it. After 20 years, it will be helpful for you. The point is, the purpose of life is living. The purpose of life is not seeing Excel sheet growing. So one of the things which we try doing in our firm is that we try to ensure that clients have money for themselves, for their aspirations. So if my client is not withdrawing money after 5 years, 7 years, I'll go to him and say, look, your car is getting old. Why don't you sell some portfolio? You have made enough money and buy a new car. Or you haven't gone for a vacation. Why don't you break some money and take that vacation? So I think that is an approach we should take, because if we do this, then next thing plays out. If we give those aspirational fulfillment to the client, it's not just client who sticks with us. Client's family also sticks with us. And that's where I think this slide is very important, that at times, we as advisors, we go, meet the client, discuss with the male members of the family. We don't even involve women in the house in the investment. I don't have a number, I don't have a projection, but I guarantee you, 50 years from now, the wealth which would be held in terms of AUM by women would be equal or higher than what would be held by men. Because with the way things are changing, women are inheriting a lot of money, they are entering into workforce, and their earning potential will keep on increasing, because at some point, certain fields like artificial intelligence, like areas which require a lot of creativity, are the forte of women. So from that point of view, please give attention to that. I've taken one example. Last year, a lot of big movies came, like Oppenheimer. But the biggest or the most grossing movie last year was Barbie. It got around, I think, $1.6 billion. And this was targeted at women, women of a particular age. Still, this got 1.6 billion. So imagine the kind of money which women have and they spend and they can invest. Lastly, about diversity, I think a lot of us are missing this point, but in our teams, in our AUMs, diversity is very important. So sometimes, one of my partners would go meet a client who would claim that, he's a gay or she's a lesbian or LGBT or any of those things. Instances are few, but there are people who are okay accepting that and talking about it. Now, at that point of time, do we have the intellectual maturity or the mental maturity to handle their finances in whatever way they want to do? So the idea here is that we should be more understanding about the needs of the client than by putting our cookie cutter formulas to them because we have been living with those ideologies. So I think this is what I wanted to discuss. I'm sorry I took 2 minutes more, but I hope it's good.
Thank you, Harsh.